In this video, we'll cover all the numbers you need to be aware of when investing in property. Knowing your income and expenditure is a crucial factor of successful property investment. There are three key areas. First, the rental return on investment, which is how much you get back on a monthly or annual basis versus what you put in. Next, the capital gain, which is how much your property grows by during the time that you own it. And last, the combined return on investment, which is an accumulation of the above two numbers. The best way to demonstrate this is with a live example. The numbers I'm going to show you here are from real life property investments that clients have made with their assistance. This example is for a client who has created a company to hold her property assets and has taken an interest-only mortgage. Typically, company ownership is the most tax efficient way to invest in property today, but we'll be happy to discuss the merits of company versus personal ownership for you specifically. Note that we invest in prime assets that deliver continuous rental and strong capital growth. Okay, from the outset, we need to understand what it will cost to acquire the asset. Here we see the property value, £150,000, and a 25% deposit of £37,500. Add to that legal fees, mortgage broker fees, stamp duty, and our fee of £3,000 plus VAT to provide your total upfront investment figure of £48,700. Next, we move through to the numbers surrounding the ownership of the property. In this example, the rental achieved is £850 per month. From this figure, we deduct mortgage payments, letting agent fees, maintenance allowance and building management fees. This gives us a net figure of £336.50 per month, which is £4,038 profit per year. When we take this annual profit figure of £4,038 and divide it by your initial investment figure of £48,700, we get your rental return on investment. This tells you what you got back for what you invested, in this case 8.3%. Next, we want to forecast how much property will grow by in the time between buying and selling it. Forecasting should always be conservative, and you should always be aware that your final figure may be above this, but could also be below it. In the 25 years from 1995 to 2020, the average property price in the UK rose from £55,000 to £230,000, and that's an average of 12% growth per annum. So bearing in mind that forecasting should always be conservative, we work on a forecast of 3% growth per annum. So to take your £150,000 property example, in a 10-year period at 3% growth, this would be worth £201,587, which is a gain of £51,587. Over 25 years, that comes to £314,066, which is a gain of £164,066. Bear in mind, the property didn't cost you £150,000, it cost you £48,700. Finally, we look at the combined profit and overall return. In the 10-year example, take your sale price of £201,587 and deduct your interest-only mortgage repayment of £112,500. This leaves you £89,087. Take from that the cash you invested, £48,700, for your net capital gain, £40,387. Add to this 10 years of rental profit at £40,380, and you have your total return of £80,767. When we divide this by the initial investment amount, again £48,700, we get your return on investment of 166%. In the 25-year example, take your sale price of £314,066 and deduct that interest-only mortgage repayment of £112,500. This leaves you £201,566. Take from that the cash you invested, £48,700, for your net capital gain of £152,866. Add to this 25 years of rental profit at £100,950, and you have your total return of £253,816. When we divide this by the initial investment, again £48,700, we get the return on investment of 521%. Succinctly, in 10 years you get £80,000 profit, and in 25 years you get £250,000 profit, all for an initial investment less than £50,000. From this example, you should now understand the income and expenditure of property investment and the profits that can be achieved when done right.